Okay, so for this section, we are going to do a review part for your post-test. Okay, for your post-test, there's total 10 questions. Okay, so that's why I'm going to review this in 10 questions. Okay, you will have 4 calculation and 6 concept question. Okay, so let's take a look at the first calculation. Okay, all the calculation is pretty simple. Okay, just make sure you have your calculator with you. The post-test, the first one is talking about calculate the mortgage. Okay, so basically, if you borrow money from the bank, they will say, okay, your monthly mortgage payment is $1,000 if it's 30 years mortgage. And in this question, they want to ask you to calculate how much money you paid with 30 years of mortgage if you pay monthly $1,000, and then compare with your originally mortgage money principal you borrowed, then figure out how much interest you paid. So here we find out, okay, you pay $1,000 every month, and then you pay 12 months every year, and then you paid for 30 years. So you time this together, total money you pay back to bank is $360,000. Okay. However, if you look, your originally mortgage principal is how much money you borrow from bank is 200,000. So the difference between them is the interest you paid. Okay. Second one is talking about decision on purchase. Okay, so let's say you pay $100 to hire somebody to mow your yard every month. Okay, and now you decide you're gonna purchase a lawn machine by yourself. So they're asking how many months you need to break it even. Okay, so think about that. This lawn machine, it costs you $1,000, and then actually it costs you $100 to hire somebody to do the job. So 1,000 divided by 100 is 10 months. So which means in 10 months you will be breaking even. All right, next one is the calculation regarding to the health insurance. Okay, so here assume your insurance pay 90% after you make 100 deductibles. Okay, so in that case, you have to pay the first $100 first, and the rest of money insurance gonna pay 90%. So the question is, if the hospital bill is $1,000, how much you need to pay out of your pocket? Okay, remember, first $100 you're gonna pay out of your pocket 100%. So first $100 deductible, you are gonna fully pay it, and then after you pay that $100, rest of them insurance cover 90%, which means you covered 10%. So $1,000 you bill, first 100 you pay 100%, rest of them insurance pay 90%, and you only pay 10%. So 10% of that $900, which is $90. So totally you only need to pay $190. Okay, so the following is regarding borrowing. Okay, when you borrow money, not only you need to pay interest. Usually when you borrow money from the bank, there's service fee, processing fee, filing fee, and this fee is also the cost of your borrowing. So in that case, when you talk about the financial cost for the loan, you need to add all of them. Okay, so in that case, we can see the borrowing is $1,000. Okay, 5% service fee and $70 interest. So the service fee will be 1,000 times 5%, which is $50, plus $70 interest, that is 120. That is the total financial cost for the loan. Okay, now let's look at the concept. The first concept is talking about the life insurance. They compare the term life and the whole life. Remember, the term life, they're gonna charge in the lower premium because every time when the term ends, when you renew it, they will have a chance to bump up the premium. Okay, so in that case, to purchase the term life and the whole life, if it's the same coverage, term life is always cheaper than the whole life. Okay, however, you do need to recognize because you have to renew it every term and if you want to cover more time. Okay, next concept is about the CD portfolio. In chapter 4, we talk about a different kind of saving method. CD is one of them. However, when you put the CD, you usually lock your money in a certain period of time, no matter it's 3 months, 6 months, a year, okay? But the CD portfolio, what they did is you can combine the CD that due different time of year. So some due 3 months, some due 6 months, some due a year. So every period of time, you will have some CD matured, and then you can have money and without pay penalty. So this saving method for the CD portfolio is actually make your saving more flexible and more liquid. Next one, we're talking about borrowing money to purchase a car, okay? We talk about purchase, actually, we have pre-purchase activity, evaluate all the alternative and make the purchase, post-purchase activity. Before you make the purchase, you need to say, okay, when you need transportation, you don't have to buy a car, you can leasing a car. Okay, so compare leasing and buy a car, there's disadvantage and advantage. Okay, leasing a car, one of advantage is usually low down payment, low monthly fee, but remember leasing, you don't have ownership for the car. So in that case, that is a disadvantage for that. Okay, next one, is talk about time value of money. We actually touched that concept in chapter 1, okay? We talk about, okay, if you do want to save money, let's say for your retirement, it's better to start early time than start it late, okay? Because when you start at early time, let's say, you don't have to save so much money, but because its time is long enough, that money can grow more time value of money, okay? When we talk about time of money, we talk about how to calculate the future value, present value. So, but basically all of this is just tell you, if you give it longer time, that money will grow time value of money, which is interest, okay? Next one, it talk about the purchase house. Okay, so if you consider to the purchase house, what is the factor you need to consider? Remember, every time when you need to make the purchase, there's two things. First one, you want it. Second, you can afford it. Okay, so when you purchase a house, the first one is, do you need a house? Second one is, can you afford it? So when we talk about can you afford the house, of course, you need to have enough money for the down payment, and also you need to make sure your job can make sure you pay your monthly mortgage on time every month, okay, for next 30 years or 20 years, okay. The last question, okay, so it's talk about, all right, so if in case you have a hard time to catch up your bill, for example, for COVID-19, you lost your job, you cannot make the payment, okay, how to manage your finance, okay. Remember, if you have a hard time to catch up your bill, first one, you need to contact the company to say, hey, I have a hard time to pay you, let's say mortgage. Can I make certain arrangement? Most bank, they rather hear from you and know you're trying to make at least a little bit payment or give you some more time you will have make payment other than hear nothing from you. So first one, you need to contact your bank or any company. You need to make the pay, okay? If you have problem with your rent, you need to contact your landlord, okay? So first one, you need to communicate with your creditors. Second is, of course, if you don't have enough money to make your bill payment, guess what? You need to reduce your spending and then find other source of income, okay? So that is all for the post-test review section. Hopefully that helped. If you have any question, feel free to let me know.